Good afternoon, everybody. Today is February 24th, 2022. We've had a lot of action in the market today. We're in the middle of the quarter. It's time for an update. We've had sort of a tough start to the year for stocks. So we just want to give you an update and tell you what that means for you. We'll get started.
Let's get right in here. Today's update is called Powell and Putin. Jay Powell is the head of the Federal Reserve for the United States, the people that create money for our country and manage our monetary system. Putin, obviously, runs Russia, and Putin today, moved into the Ukraine, as people have been expecting he would do. And without sounding too crass, we want to talk very briefly about what will Powell do. What will the Federal Reserve do? They've been talking tough. We ended our last quarterly newsletter saying that Jay Powell and the Fed have been talking mighty tough about battling inflation. We're going to see what they do. Now, the invasion of the Ukraine may allow Powell and the Fed to not be as aggressive as they were going to be. We have long contended, and if you've listened to us on these videos, you know that we have been somewhat skeptical about what the Federal Reserve would do about not only inflation, but their direct intervention into the markets, which they continue to do. Even now, they're continuing to do it. After their tough talk, they continue to buy bonds, which is rocket fuel to the stock market. They continue to do that. They're running out of room, and we contend that they may not be quite as aggressive and may be looking for a bit of an excuse to tone down what they do. Not necessarily what they say, but what they actually do. The first chart we want to go over is NASDAQ. Now, we are focused on the NASDAQ right now. The NASDAQ, you can see here, was trading over 16,000. This morning, we got down to, these marks are right at about 12.5, 13,000. This is a decline of 20% right here, a little over 20%. Why is that important? Because once we cross 20%, we're said to be in a bear market. The NASDAQ has had a more dramatic decline than the S&P 500 and the Dow Jones Industrial Average. The Dow Jones and the S&P down more like 10 to 12%, NASDAQ down 20%. The distinction is important to us because once you get down over 20%, you're said to be in a bear market. Those are different than just normal corrections. 10, 12%, that's a pretty normal correction for the stock market. Haven't had one in a long time since the Fed jumped in and provided all the rocket fuel to the market back when COVID started. They jumped into the market. They didn't pour kerosene on the fire. They poured high-octane jet fuel into all markets. And our contention has been that you need to be a little bit skeptical of the things the government gives you, because if the government gives you something, they can certainly take it away. So some of these gains we have felt like were certainly fueled by nothing more than liquidity pumped at a high rate into the system, money created and pumped into the system. That is jet fuel to all these markets. And nothing is free. And there's a price to pay for that. Now, it hasn't felt like it, but there is a price to pay for that. A lot of people, me included, all of us up here at Optimum, we've been a bit skeptical about all this free printed money stuffed into the system. We've been hyper-focused on the NASDAQ lately because we're starting to get interested at this 20% line. You get down 20% pretty quickly, we start to get interested in it. And so it's been a tough opening to the year. Here's the beginning of the year. Here's the high. So it's been tough. Now, we may be living in this area for a while. We certainly don't expect it to go right back up here, obviously. But we're looking to maybe start averaging in. We get interested down in here. That's why we were so focused on it this morning, to see where it would go. And it did honor this line here. So we're watching this line here. and we may be, we start to get very interested when we get towards these points. And again, people have short memories and forget that these markets can correct. And in fact, they can enter bear markets. Bear markets come along from time to time. They are not pleasant. They're not nice. They're not fun. And are we in a bear market or are we in a correction? So that's the stock market. We're really focused on the NASDAQ right now. All of you that have watched these videos since 2019 know that we have a tendency to show the same charts to let you know what the major things in the market, the 10-year Treasury, this is interest rates on 10-year U.S. government Treasury bonds. This is a huge benchmark for the bond market and for the stock market too. Everybody that does this for a living is focused on this, or should be. If they're not, then I don't know what they're doing, but we are certainly very aware of where the 10-year Treasury is trading every day. Now, these are the interest rates. As we've told you before in all these videos, this chart goes back to 1999, but this is a 40-year decline in interest rates. So if you're a 60-year-old person, you've lived as an adult in a world of nothing but declining interest rates and rising bond prices. You've never known a hard bear market in bonds because there hasn't been one. So you've lived in a world where interest rates only do one thing, and that is decline over time. Now, are we at an inflection point? We'll talk about that in a bit. We think that the government, the Fed, is going to keep these rates tamped down. Now, they say they're going to quit buying so many bonds, but we've also told you in the past, they are terrified to let markets trade on their own. So we feel like the Fed, the government, through the Federal Reserve, may keep these rates in a range. Now, these red lines are resistance. Tough for these things to get through these red lines. You can see that we're through it. We recently went up slightly above 2. When I printed this morning, it was 194, 1.94%. That's percentage. So if you bought a 10-year Treasury this morning, you could get 1.94% interest on your money for 10 years. Everybody, again, the reason we watch it is because this is a bellwether for the stock and the bond market. So if you want to know you always want to know what the 10-year Treasury is, where it's trading. So again, we feel like that we may be in a range right here. We feel like the government may continue to keep these rates in a range going forward. Tough to get through these red lines. So that's kind of what we feel about government interest rates. The last slide is going to be also related to this, but it answers the question, hey John, what are you watching very closely? Sometimes people want to know, what are you watching? So I'll talk about that on the last slide. This is the gold chart. Everybody that's been watching these videos know we bought gold right before COVID hit. It's been a good trade for us. This is a long-term chart that goes back to 1999. This is called a cup and handle formation. This is considered to be a bullish formation. We feel like that this handle, and this green is just me coloring this in so you can see it. We have felt like that gold prices, since we've owned them, would follow this handle. And it pretty much has. Now, this is a longer term support line. This line goes back to about 2005, 2006. And you can see this is a long-term rising line for gold. And we felt like that it would honor this. Now, today it went way up. It went up very hard this morning. Now, it's since relaxed, and we feel like it'll relax and sort of honor these lines, but eventually work its way back up into here over time and try, hopefully, to take out this $2,000 all-time high. Now, we don't particularly like owning gold and silver. It's been a good trade for us, but we don't particularly like it. It's very volatile, but we bought that because at the time, interest rates very low, very low interest rates, and all the governments of the world are devaluing their currency by printing more and more and more money. And historically, that has been an okay time to buy gold and silver. So it was really a hedge against paper, the devaluing of paper money, more than anything else. Because, all our stocks and bonds are denominated in dollars and paper money. So if it's devaluing, we want something to sort of offset that. So sort of a hedge against paper. And it has followed about like what we thought it would do, up real hard early this morning, but we suspect it'll come back down in here, maybe, test and retest and work its way back up, and eventually think it may test this old high at $2,000 an ounce. Now, this is what I am watching pretty closely. We watch this relationship. This is IEF, is an ETF that owns a lot of government bonds due 7 to 10 years from now. Kind of like that benchmark 10-year treasury is a benchmark. These are just intermediate term government bonds. J&K is an ETF that is just a big pool of low credit score corporate debt. And the slang term for low credit score, low grade corporate debt is junk. I'm buying junk bonds. Now, we don't particularly buy junk bonds. We don't particularly like junk bonds. If we're going to take that kind of risk, we would rather buy a stock. They are similar in the way that they act. So if we're going to take that kind of risk, we'd rather just own stocks. But this relationship, I'm trying to show you what I watch. I look for points where they start to separate. This is government debt. When government bonds rise in value and junk debt declines in value. Those are important inflection points. We watch those very closely. So you can see points, this is 2015, where government debt started rising in value, junk debt started declining in value. That was an important point there. Then they trade sort of similar. This is green, kind of trading together. And look, COVID hits, junk debt really declining in value very hard, really got hammered. Government debt, people bought it and pushed the price up. Junk bonds, everybody was freaking out and they were selling junk bonds until, now you can see this huge rally, until the government started buying junk debt, which a lot of us really were just put back by the Fed's willingness and actual buying of junk debt. I'm not going to get into that. It makes me irritated. But a lot of people, not just me, were really taken aback by the Fed jumping into this market and pushing these prices right back up. There are very cynical reasons that a lot of us hold for why they did that. But anyway, you can see, again, important. We're looking for these relationships going up, going down, trading together, roughly sort of trading together. Now junk debt is starting to go down again. You can see the price moving down. Treasury's kind of flat, kind of flat. This is a longer term chart. If I had a shorter term chart, you could see that treasuries have sort of flattened out while junk has started to go down. Now that, we are noticing that divergence between the junk and the government debt, government bonds, junk bonds. So we're watching that relationship very closely right now, along with the NASDAQ. So I hope that's been helpful to you. That's what we're looking at. That's what our take on it. If you have any questions, please don't hesitate to call us. We'd love to hear from you. Thanks.